So welcome, folks, to the latest rendition of my series webinars at Epic Street. Thanks again to everyone at Epic Street for making this event possible. Thanks to each one of you for attending, for making it what it is. Let me first remind you the purpose of this event is education. I'm not going to provide specific trade alerts or trade recommendations. What I will do is take a look back at what happened today and take a look ahead and ponder aloud with all of you what might happen, not just tomorrow, but over the course of, say, the next week or more. This is my typical view of multiple charts, multiple currency pairs, plus I usually throw in one of the equity futures markets. Let me adjust this windows on the side here. On the lower left is DAX futures. I track DAX futures, as many of you already know. Because it's shown in the past. It's not a perfect correlation, but at times it's shown some correlation. You don't see my cursor, sorry about that. At times DAX futures has showed correlation with the Euro USD, so I monitor that from time to time. Well, let's put this another way. We've monitored as currency traders at FX Bootcamp and coaches as well. We've monitored in the past correlations between currency pairs like the Euro USD and the major equity market indexes such as the S&P and the Dow in the U.S. and of course the DAX in Europe and such. And more recently of the correlations that I've been tracking, the DAX or more broadly speaking, the major European equity market indexes have shown better correlation with the major currency pairs like the Euro USD that have the U.S. equity market indexes. Now again, it's not perfect. It's just the correlations are mixed from time to time. Or not different things like Euro USD versus DAX futures don't move in lockstep all the time, but it happens often enough that it's worth at least tracking what the DAX is doing. And by the way, that's a change from what we did, a year or 2 years ago. We were following much more closely indexes like the S&P 500 index in the U.S. But as many of you know, given all the attention on Europe these days, it seems logical to focus more on some of the European financial markets, like the DAX, like the European government bond markets, and the correlations, maybe not until recently, have borne that out that it's worth tracking those. So what happened today? Well, you know what? I'm gonna go take a step further back and look at what happened last Friday in response to the Nfp report. I'm guessing at least a couple of you, maybe more, attended the FX Street's NFP event last Friday during the New York morning session. And some of you may recall if you did attend this, we talked about the historical reactions over the course of this year, especially the past 3 or 4 months. The reactions on the Euro USD currency pair, which you're seeing a chart for right now. Reactions on the Euro USD currency pair in response to the previous NFP reports. I talked about this in a special open mic night event at FX Bootcamp. This would have been during Friday's Asian session. And then I talked about this also in advance of the release of the Nfp Report during FX Street's NFP event on Friday. And what we talked about, and I can show you the charts if you want to see them. Unless anybody requests the charts, I'm just going to plow on. But what I talked about is how relatively choppy the price action has been in recent months in response to recent NFP reports. One classic reaction has been for the euro to move initially in one direction as an initial sort of knee-jerk response to the NFP report, and then go in the opposite direction, sometimes longer than you think. And that's pretty much, you didn't want to insult me. I see it. I just saw your latest comment there, Maud. And Maud, it's hard to insult me. I'm an old guy, gray hair on the sides above the ears. It's tough to insult me unless you make fun of my shirt. Do not make fun of my shirt. That's where I draw the line. Just totally lost my train of thought. Where am I? Oh yeah. So Friday's reaction, NFP. It's been far too common in response to NFP to see the euro flip either from down to up minutes after NFP, or in this Friday's case, it was from up to down. And I'm going to add a vertical line to this chart so you can see the post-NFP reaction. So everything to the right of the red vertical line in this 15-minute chart, that's the reaction. You can see the drop in the euro as the New York morning session on Friday unfolded. That was the reaction to NFP. Now, let's talk about NFP real briefly. I'm not going to, I could show you a whole slew of different graphs and charts and tables and even dig into the NFP report itself. And again, if there's anyone who really wants me to do that, so I could do that. But I can summarize for you, at least verbally, the basics of last Friday's NFP report. First, we as I've been discussing in recent webinars here at FX Street, as I've been discussing, the market responses, been right or wrong, whether I like it or not, whether any of you like it or not, the market's responses to recent U.S. economic reports have been rather lame lately. In other words, the market just has not shown much reaction. The market has not shown much volatility in response to U.S. economic reports the way it used to in months and years past. Now, maybe we'll return to a time here. Maybe it's going to be next year we'll return to a time where the market will be more sensitive to U.S. economic reports, but that's not been the case. That's not been nearly much as the case lately. So you got that going on. Well, this Friday's report from last Friday, what it showed was not much of a change, not much of a deviation from expectations when it came to the headline number for the estimated change in U.S. jobs. I believe that what was that number? Something north of 120,000. I usually remember numbers pretty well, but I just haven't been paying that much attention to NFP because it just hasn't been doing anything that meaningful. Anyway, we saw some job growth according to the headline number from NFP, but it wasn't much of a deviation or difference from expectations from what the forecast number was, according to surveys conducted by news agencies such as Bloomberg, who compile these estimates of what different analysts and banks think what the NFP is going to print. They gather all these estimates and pick the median number of all the estimates, and boom, that's the consensus forecast. And what traders like to do is compare the consensus forecast to the actual number and then trade accordingly. Well, there wasn't much difference between the actual and consensus numbers for NFP. But one figure from the report that some might cite as a factor behind the drop in the Euro USD, I have my doubts about this, but some are trying to call out the drop in the unemployment rate. For those who don't know, the U.S. unemployment rate dropped in November, according to this latest NFP report, dropped to, 8.6%? 8.6%. And that's a notable drop below the recent 9+% levels that we've seen in terms of U.S. unemployment rate. Many of you may already know this, but for those who don't, the unemployment rate is in many occasions very deceiving. Very deceiving to use that as a gauge for employment levels in the U.S. And here's why. It's the twisted sort of way the Bureau of Labor Statistics counts or calculates unemployment level goes like this. If you are not working but actively seeking a job, you are counted as unemployed. If you are not working in the U.S. but not actively seeking a job, you are not counted as part of the total number of people that go into the estimate of the unemployment rate. And what happened in November, and again, these are all estimates, what happened in November, there was some 315,000 people in the U.S., again, this is an estimate, that dropped out of the count or tally of those unemployed in the U.S., but also actively seeking a job. So in other words, and this has been happening regularly over the past several months, and actually really since the global financial crisis unfolded here. What's happened is that people are getting discouraged in the job search and are just dropping out of the count. They're no longer being counted as unemployed and actively seeking. That's what determines the unemployment rate. So the unemployment rate dropped at least in part because those who were formerly considered part of the available workers are no longer being counted as such. Other part of the story, there was some job growth according to the household survey. By the way, the NFP report produced is derived from, or the results of that report is derived from two surveys, a survey of a so-called establishment survey and a household survey. The establishment survey is based on surveys of companies, mostly large, some medium-sized companies. The household survey is based on phone calls of a sampling of U.S. households. It's been considered a proxy for growth in this, or lack thereof, lack of job growth sometimes, in the small business sector. So it's the household survey from which is derived the unemployment rate. The headline number from NFP, in the case of November, was something north of 120,000. That's from the establishment survey of companies and what they're doing with hiring. So again, the headline number, not bad, better than expected, at least positive. The unemployment rate would seemingly at first glance be a positive, having dropped, but that drop not entirely due. In fact, not even I don't think it was even quite half due to a generation of jobs. It was as much a factor. Behind that drop in the unemployment rate was simply fewer people being counted as unemployed and available for work. So anyway, the conclusion from the NFP report last Friday, a mixed bag. Not a big deviation, a small deviation actually between the expected and natural from the NFP report. Plus, if you look into the report, look at the details, a mixed bag. So does that account for this drop in the euro Friday? Does the drop in the unemployment rate account for the drop in the euro on Friday? I would guess not. Some would say the notable drop in the unemployment rate was a factor. I would guess probably not, but that's just me. There were some rumors floating around, by the way, on Friday, trying to attribute to that drop. And one of them was, I believe, a suspected downgrade in Spain's sovereign debt rating, which didn't make any sense because Spain has recently been downgraded. There was another rumor. There was one. There was talk about some legislation in the U.S. and in Washington D.C. legislation to block U.S. Treasury from funding an IMF bailout of Europe, and there was concerns about what's going on in Iran and such. But whatever the case, the euro sold off. The euro sold off on Friday. Jana, you talk about an ECB intervention. Define intervention. Intervention in the classic sense, in terms of most currency traders consider intervention. The ECB has not done that. The ECB has not yet done that with a classic intervention. Now, if you're talking about intervention from the perspective, maybe what you define as intervention is the ECB buying bonds, and that's still in question right now. How much more bond buying? To what degree will ECB eventually ramp up their bond buying? I'll get to that in a little bit, if that's what you're referring to, what the ECB might bring. We have a European Central Bank rate decision and governing council meeting on Thursday, and there's certainly some speculation as what the ECB might do on Thursday, also what the ECB, in many people's opinion, should do on Thursday. Now, that could be very much two different things, but we'll get it. So again, what I wanted to cover there was the move on Friday, and now, was that easy to trade? Not at all. The euro rose in response to NFP report by some 30 or 40 pips, and then dropped by like 20, just in the course of the first minute. And after that, from the first minute after the release of the NFP report, it was more down than up. Not an easy move to trade. And the move thus far today, it's more like the euro just clawing its way back. Now, if I zoom out, you may recall this the move on Wednesday in response to the Federal Reserve cutting the cost of U.S. dollar swaps. It gave the market gave the euro a notable boost. But for all practical intents and purposes, the drop on Friday gave up not all, but a lot of those gains. So anyway, let's get to the trade. At least I would argue that one of the trades of the day when it came to this pair, the euro USD. And by the way, there were similar trades involving still in the dollar against other currencies, but I'm going to speak mostly in regards to the euro here. Actually, let me go to the 4-hour chart first. You should see a 4-hour chart now, and I've got a horizontal blue line in the bottom half of this chart at 3420. I've talked about this 3420 area many, many times before. If you've attended any of my recent webinars, You may recall me mentioning this in the past. It's not too difficult to see. I've got some blue arrows on this chart as well. I'm referring to the lows established by this pair around the middle of November. Those lows in the 1.3420 to say about 35 area, 134.20 and 35 area. Again, the horizontal blue line represents 1.3420. If I go now to an hourly chart, you can see the lows from about the middle of last week. I've got my cursor near those lows. See how those lows were respected at 134.20 level? So 1.3420 has been important to the euro on multiple occasions over the past several weeks. With that in mind, let's go to a 15-minute chart. And what we talked about during the early part of my coaching session today, my coaching session at FX Bootcamp covers from 6 a.m. to 9 a.m. New York time. During the first hour of of my coaching session, we talked about a long on the euro, just above 1.3420. You can see if I highlight with the blue arrow here, you see today's early Asian session highs, just above 34.20. So you had some evidence today. Actually, you can point to some more hesitation earlier today around 34.20. So again, on the area, the 34.20 area, stressing the word area, an area that's been important in the past, an area which seemed to put a lid earlier today on the euro, became support. That was the idea behind a long. Let's see, you could have been long 34.25, 34, maybe up to 34.30, something like that, a long in through here. And the move of the day took us up to about 34.85. Why there? Debatable. One of our members at FX Bootcamp was referring to a trend line there. I can show you that. I think the trend line that one of our members referred to is this. And I know I've got some other stuff on this chart, so it may be a little difficult to see the trend line. Actually, let me make this trend line thick and green, only just so it stands out, not to indicate that's the be-all, end-all trend lines. Well, there's the trend line that one of our members pointed out. That's a possibility. Possible factor behind defining today's high. Another thing to bear in mind that when it comes to the Monday after NFP, the Monday after the release of the U.S. Non-Farm Payrolls Report, we do commonly see volatility a little lower than normal. And let me get rid of the green trend line for now. I already made the point with that. You could also make the case for. Let me move this vertical line. You can also make the case for applying a Fibonacci study to Friday's move down. Notice the 61.8% fib of Friday's move down at 1.3478, very close to today's high. You know, I am omitting one trend line on this chart that I had drawn in the past. And that trend line goes back to I believe the November 25th low. Let me add that now. I thought I had that trend line. I thought that trend line was a little higher. Maybe not. Maybe confuse it with another trend line. No, I'm going to delete that one. So what can I say? I mean, the feature move today, and just in terms of the euro was that one, long and around 34.25ish, and you may not have picked today's high, but you certainly locked in some profit from that trade. In fact, as I see it, the hope was, if you took the long, the hope is that once we broke above today's early London session highs, that we would stay above that and continue higher. So you would have anticipated, I'm looking on the right-hand side of this 15-minute chart without indicators. I'm going to use a blue arrow to identify a bounce in the 34.50 area. You could have reasonably anticipated that bounce and stuck with it. But then when we topped out over the course of I guess you can call that double top around 85. Once we topped out there and we got closer and closer to the end of the European trading day, you either got knocked out or you decided, hey, enough is enough, I'm done with the long that is. Now, going back to the original long around 34.25 during the 6 a.m. hour in New York, as that was setting up, then there were other opportunities to short the dollar against other currencies. One of those was on the British pound. And you had roughly similar technicals here as well on cable. The opportunity to long was that they came together as the euro was finding support around the 34.25 area. Cable was bouncing about right there, just above 56.20. And you could have applied the fib study of the London session rally. We had actually a 50% fib near there. So really, the same kind of trade, based maybe in part on the expectation that the euro would bounce. And if you expect that the euro is going to bounce, the dollar is probably going to weaken. If the dollar weakens, that means up for the pound dollar. And the benefit to taking the cable trade was that we did see some unique strength in the British pound eventually emerge, and cable simply ran farther in terms of pips than did the euro. Which I must say is a little bit unusual recently, because recently I've seen that the euro has shown more volatility than pound dollar. It's a bit unusual historically. Historically, the pound dollar currency pair has shown more volatility than the euro has. Hasn't been the case in recent weeks, though. And there was a little volatility in the yen crosses, as there almost always is, but yen crosses weren't all that inspiring. But again, this is one of those days where there were pips to be had, but this is a day where and we talked about this in our cheap currency growth Will McDonald's coaching system today. This is a day where if you expected too much and overtraded as a result, you could have dug yourself a hole today easily by either looking the wrong way or taking too many trades, expecting something to work, or changing your mind about whether you're a bull or bear and going long and trying to go long. Well, long doesn't work, so then you go short. Well, short doesn't work. Then you go long again. Long doesn't work. This is the kind of day where, and unfortunately, it's very common for newer traders to get into this trap of you're gone for the weekend, you're away from the charts for the weekend. Maybe you come back rested, you come back energized, you're ready to go, eager to trade, and you face a market that, for all practical intents and purposes, doesn't go anywhere. And by the way, if I haven't mentioned, I think I did, but if I haven't mentioned again, the Mondays after NFPs, the Mondays after NFP reports tend to be lower volatility days. The market just, on average, I'm using the Euro USD as a proxy. The Euro USD on average just doesn't move as much on Mondays after NFP as it does on virtually any other trading day. Of course, I would say part of the theory behind that is historically, the non-farm payrolls report has triggered some decent volatility, a sizable move. And whether it's the Euro USD or any other currency pair, or for that matter, any other market, after big moves, a common occurrence is consolidation. So historically, some consolidation after a big post-NFP move, reasonably common. But as I said earlier, we haven't seen that much volatility recently in response to NFP reports. So that whole phenomenon about low volatility on post-NFP Monday, may not be so much a factor anymore related to NFP, because NFP just hasn't moved the market that much. But we did face something that could move the market. I didn't mention this earlier. It's worth you mentioning this. One of the reasons we discussed for a long on the euro, again, the long around the 34.25 area earlier, one of the reasons we mentioned for long was to sort of front run a statement that was due to be issued today by Merkel and Sarkozy. For those that don't know what I'm talking about, and hopefully by now you do. If you don't, you got some studying to do. German Chancellor Merkel and French President Sarkozy met today, and they were discussing, among other things, their differences with regards to their plans or their wishes or goals when it comes to resolving the situation in Europe. So they met in Paris today, and initially what I was hearing late last week and over the weekend was that there would be no statement issued by Merkel and Sarkozy, but in fact there was. They did issue a statement. And so again, the idea behind the long was to potentially front run that and get in a position before the market responded to either any actual statement from Merkel and Sarkozy or even any rumors about what Sarkozy and Merkel accomplished or did not accomplish. In today's case, the idea was the expectation that, as I discussed during my live coaching session at FX Bootcamp, I didn't anticipate, if history is any guide, I didn't anticipate that Merkel and Sarkozy were going to come up with, that we're going to say or do anything that would discourage the market, at least not today. So I figured, any fluff, any, I don't know, locking arms and singing Kumbaya or what, anything that Merkel and Sarkozy had to say or do today was likely not to be perceived as a big euro negative. They were going to try to show some unity and at least give the market something to chew on. Although, as it turns out, it seems they were rather vague, and you can see on this. You can see on this chart. Let me move the arrow to highlight this. I just highlighted with two blue arrows the move in response to the statement by Merkel and Sarkozy, and that was it. And my perspective as I look at that move, and the euro, a couple hours later, undid what little rally we got in response to that. The market doesn't seem too enthused by what it got from Merkel and Sarkozy. But then again, they were both they were a bit vague. There was lacking in details, which has been a very common thing amongst European leaders, lacking in details when it comes to any plans, any actions to address the situation in Europe. Yeah, I mean that's pretty much what I've discussed at boot camp lately. Is not that much lately, but in terms of late last week and even today. Talked about, I think I mentioned this. I may have mentioned this at one of these webinars last week, but I know I mentioned it at FX Bootcamp. 3 dates. I've mentioned 3 dates. I would add a fourth to it now, but at least 3 dates that I would mark on your calendars. The first one is Thursday. Let me get my dates right. Thursday the 8th. Thursday the 8th, as Gam's already mentioned. Gam didn't mention the date, but Gam mentioned the event. You mentioned the EU. I would call it the ECB interest rate. I would call it the ECB policy decision. Yeah, it's probably going to involve a cut in their main interest rate, but it may involve even more than that. Maybe some new liquidity measures, and who knows? Maybe they're going to announce something unique or different with regards to their the Securities Markets program, the bond buying program. So anyway, Thursday, ECB meeting and policy decision. So you can refer to it as a rate decision if you want. I think of it as a policy decision because a policy move by the ECB could easily involve much more than a rate change. So that's one event. Second event to look for in terms of a source of volatility. Friday, the European Union Leaders Summit in Brussels, right? EU Leaders Summit on Friday. By the way, this is being increasingly billed. That summit actually is increasingly being billed by the media. Of course, the media likes to hype things up, and the media gets plenty of things wrong when it comes to its hype and such. But that's being billed by some as the summit to save the euro. I don't know if that's true, but boy, if you look at the latest Commitment to Traders report, you certainly get an idea of what the hedge funds think about this. Yeah, thank you, Dan. There is a Bank of England rate decision on Thursday, but honestly, Dan, I think it takes a backseat to the Eurozone. I really do. And of course, the Bank of England just recently announced another QE program, so I think any surprises, anything new from the Bank of England's likely off the table for now. I think I sense the Bank of England's done their thing. Now it's, and when it comes to the policymakers in the UK, they're all looking to Europe right now. Yeah, Gammon, I would agree. So that's Thursday and Friday. Next Tuesday, a week from tomorrow, FOMC. I'm guessing that'll probably take a back seat as well to the events later this week, Thursday and Friday. But what FOMC might bring, if I'd say this is a tail event. I'll call this a so-called tail event. It's not the likely case, not a base case. Something to watch out for. In the case that the ECB doesn't deliver anything meaningful on Thursday, and the European leaders on Friday don't manage to get anything done, is it possible that there's some sort of policy change by the Fed? Maybe. I really doubt it. But I suppose it's possible the Fed could do something. What I say is more likely on next Tuesday. When you look at the Fed decision, I don't think they'll do anything. But what the Fed could bring is clues to what they're considering. Maybe there's something from the FOMC statement issued after London closed next Tuesday that could spark the market's speculation about what comes next from the FOMC. Now, while I'm at it, I'm going to say that actually it's a good time to provide the sort of, I guess I've already been providing some of the look ahead that I promised earlier. I talked about, I said I would talk about, today's trades, and I'll take a look ahead. Well, part of the look ahead is, some notable news events over coming in the next several days. Already mentioned the ECB meeting. Already mentioned the EU Leaders Summit on Friday. FOMC as well. One thing worth noting when it comes to FOMC, that's the Federal Open Market Committee. That's the group of central bankers that all work at the Federal Reserve, the U.S. Central Bank. And this group meets nine times a year, I believe, and they decide on monetary policy on behalf of the U.S. Central Bank, the Reserve. At the end of the year, this happens each year. At the end of the year, there's sort of a musical chairs happens at the FOMC. There's some voting members that lose their voting rights, and other voting members, other members who don't have voting rights that attain their voting rights. And there's also, by the way, some FOMC members that always have voting rights. The Federal Reserve Chairman Ben Bernanke is an example of that. Well, and I can cover this in more detail maybe on a subsequent webinar here at Epic Street. But there's going to be a notable change in the makeup of the voting members at the FOMC starting at the start of the new year. Now, for those of you who think in terms of doves and hawks at central banks, the FOMC will turn notably less hawkish at the start of the new year. That it's very possible that sets the stage for the Fed to have the votes it needs to eventually launch what's called QE3, which, who knows, might become increasingly necessary if things get ugly in Europe, and if it has ripple effects for the U.S. Yeah, again, that's what I'm pretty sure I mentioned earlier was one of the theories behind the Euro sell-off on Friday was that there was talk about Republicans blocking legislation or forming legislation to block the Treasury from pitching into the IMF, which would in turn lend money to Eurozone states. Now, of course, that was related to Treasury. Now, yeah, there may be a separate story about blocking the Fed as well. You know what can I say? If we get any clues over time that the Fed is being seen as overly influenced by politicians and less independent, it's easy to conclude what the market's response to that would be. If the market perceives a serious lack of independence by the Fed, and that should bring with it some dollar pressure. Of course, because also depends on what's happening in Europe at the time. But one thing I was going to show you. Let me give you the latest commitment of traders report. Overlaid on this graphic will be a line chart for the euro. In a moment, you should see a graphic. Graphic shows some blue vertical lines, some pointing up, some pointing down. Other part of the graphic is a maroon-colored, sort of dark red line. The maroon-colored line represents weekly closing prices. Actually, the closing prices as of the Tuesday of each week, going back to early 2009. Closing prices on Tuesday of each week for the euro. The blue bars represent relative positioning in the futures and options market by so-called non-commercial accounts, which is a good proxy for large speculators, specifically hedge funds. Here's what it means. You can look at the Commitment of Traders report published by the CFTC each Friday. What's published each Friday pertains to market positioning on Tuesday of that week. So here's what we know. If you look at the futures plus options contracts from the Commitment of Traders report, if you look at the number of euro longs versus the number of euro shorts, there are nearly 100,000 more euro shorts than euro longs. So my conclusion, one conclusion you can draw from this latest Commitment of Traders report, the market based on the positioning we've seen over the past nearly 3 years, the market is very heavily net short the euro. There's your conclusion. The market is very heavily net short the euro. Now, does that mean that the euro sell-off is almost run its course? Doesn't have to. Notice that the market was already heavily net short the euro in like March of 2010, March of last year, and that the euro had only seen at that time a little more than half of its ultimate sell-off in response to the Greek sovereign debt crisis. But Gann makes a good point about a bounce coming. It's possible the market is poised to be for a short squeeze. That is if, and it's still an if we get some news from Europe, whether it's the ECB on Thursday or European Union leaders on Friday, which the market considers a step in the right direction, deems as a euro positive, we could have one heck of a short squeeze. We've had this before in recent weeks. It could happen again. Now, the question is, what does the market do then if we do get a good short squeeze? Some of you may remember what happened in the last short squeeze. I can take you to a daily chart on the euro, and we talked about the level that the last short squeeze hit, or I should say the source of resistance the last short squeeze hit before it got there. Let me take you to a chart for the euro here. I'm going to try to find a chart here that unencumbered by lines and indicators and such. Yeah, I'm taking you to a weekly chart for the euro. And what we talked about, put the trend line in place first. We talked about that trend line connecting last year's low with the low earlier this year. So let's go to a daily chart here. And the last significant short squeeze on the euro was right here, and this was October 27th, as you may recall. This was earlier that day. Earlier that day, there was an announcement that Greek bondholders and European leaders had come to some sort of agreement on a 50% haircut on Greek bonds. The euro rose that day by a pretty significant amount, and that was it. The euro rose one day, and it's been down more than up ever since. So, if the market perceives anything as positive out of the Eurozone window this week, then we could see something similar happen. But, it still begs the question in my mind, how much can this scenario repeat itself again? At what point does the market decide that whatever the European leaders have to offer is not going to be enough to spark at least a short squeeze, if not a new rally on the euro? We've seen this thing before. I mean, going back several months, even back to going back to last summer, for example, we saw something. Let me get back on the charts here a bit. There was a summit on in July. I think it was like July 21st or something like that. Sparked a bit of a rise in the euro. In fact, I got it right here. Let me put it. Let me put some arrows on this euro chart. Okay, I just applied 2 blue arrows to label the July 21st move on the euro. That was also a significant rally in response to that a summit held by Eurozone leaders on July 21st. And that wasn't that did not turn out to be the start of a sustained rally on the euro. Neither did the one the reaction on October 27th. So, the question a lot of traders, analysts, the hedge fund managers, the economists are asking is, how long can this keep going? How long can the Eurozone leaders keep having these summits, keep announcing the next latest and greatest solution, bailout, call it what you want, before the market stops giving the Eurozone leaders and governments runway? I viewed an interview. It lasted over an hour with Kyle Bass, hedge fund manager Kyle Bass, where he talks about the Eurozone, the U.S., and even Japan. And I like the analogy that was used in that interview, where the markets can. And the idea is that some have used the phrase "kicking the can down the road" when it comes to what some of these Eurozone governments and even what the U.S. is doing, and even Japan for that matter, what they're doing in terms of the sovereign debt levels. Kicking the can down the road, hoping that eventual return to economic growth can help solve some of these problems, can help boost government revenues and bring down these deficits. Well, another way to look at it is, running out of runway. Think of it as an airplane looking to go airborne, and is there going to be enough runway for a plane? As an analogy for an economy, enough runway for the plane to get airborne? And the comment made, I tend to agree with it in this recent interview with Kyle Bass, and I can provide a link to that for anyone who wants to see it. It's an hour-long interview, but a very good watch. Very good investment of your time, in my opinion. The analogy used in that one way is that, or the description used in that runway is that, in the analogy, is that markets, you never know when the market's going to stop giving policymakers runway. And when the market takes away that runway, stops that runway, it can do so very quickly. Yes, again, I would agree. Market's saying sort it out right now. Speaking of that 3420 area, the euro there now. And that concludes my scheduled time, folks. Pondering what else I had in mind to cover. Talked about today's euro bounce, wasn't much. Talked about the schedule, upcoming events. I would also throw the date December 19th on your calendar as well, although it's awful close to the Christmas holidays in the U.S., not just the U.S. for that matter. But that December 19th date could be critical too, because that's when Greece has some debt to roll over. So keep the date December 19th in mind as well. And it's been a rather quiet crowd, but that's not unusual. Mondays are, actually at boot camp things our traders were a bit quiet, so I guess this happens. But, I guess that's all I got. Unless there's any questions, any comments, we'll wrap it up here. Oh, yeah, Johnny, the access for the LinkedIn interview? Sure, let me track that down. Hang on. Yeah, I have a number of people that I listen to regularly. Now, I don't believe everything everyone says, and even guys like Kyle Bass say, do your homework, form your conclusions. And Kyle's one of the first to say that he's been wrong at times, especially wrong with his timing of things. I mean, there are certain, there are certain people that I know that, like hedge fund managers, for example, that I know, I can tell they do their homework. I can tell they've done their homework. They're not regurgitating old economic models. Looking at the world for what it is and drawing conclusions from that. Sometimes their assessments maybe a little bit extreme, a little overly bearish, a little overly bullish. I like that though. I like someone who can stretch my mind a bit, and Kyle Bass has certainly been known to do that. Here's a link coming. Again, it wasn't BBC Hard Talk. This was at a U.S. mortgage conference. Again, you referred to the interviewer. You talking about you said it wasn't a good interview. You saying the person who interviewed Kyle Bass wasn't good, or you saying Kyle Bass sucked? Hey, Johnny, check that link I just posted there. I'm pretty sure that's it. Oh, Gam, I see your comment now. So the interviewer had an agenda, huh? Well, in the interview this was early in November, in that Kyle Bass interview, he's given plenty of time to speak his mind. See, I hope that link worked. Now, again, that interview lasts more than an hour. Sorry about the cough there. Oh, there's a warning just issued a little while ago. S&P, the ratings agency, warns Germany and 5 other AAA rated members of the Eurozone will be put on ratings watch negative later today, according to the Financial Times. So if you're looking for reason for the Euro sell-off, that's probably it. Credit watch negative implies a 50% chance of a downgrade within 90 days. It's shocking that some countries on watch, but that includes Germany. No comment from S&P on this thus far. Yeah, and that's what I've always found about Kyle Bass. He gets into some details. I mean, he gets into some things that could be a little difficult for the novice to follow. But I consider him very well spoken when it comes to the fundamentals. So with that, folks, I bid you adieu. Let's do this again tomorrow, same time, same place. Speaking of place, maybe an interesting place here for the Euro. And notice, by the way, the Euro has more than undone any euphoria we got from Merkozy. Some of you may have heard the term Merkozy. Merkozy is a reference to German Chancellor Merkel and French President Sarkozy. You can see them again. The Merkozy comments gave them, as I described earlier, gave the euro a bit of a boost, but that boost long since been gone. And we've given up probably some 2/3 of the rally from Friday's low. So, folks, have a great day. We'll see you tomorrow. Cheers.